John, in your opinion, what are the most common mistakes made by investors when looking at fixed income investing?
The problem with most investors and how they deal with fixed income investments is they believe credit rating agencies. Credit rating agencies are the people who for 100 years have told us what the risk in a bond is. And a credit rating breaks into a couple of factors. One is, what is the financial quality of the business? And number two, what is the industry it operates within? So a company that's in a very risky or cyclical business typically has a lower credit rating, and a company in that risky business with a very high quality financial profile will be higher rated. For us, we look at from a bottom-up basis whether that company can pay us back or not. But it's not that we always buy the most highest quality investments. If you're always buying the safest things, then you'll always be getting an interest rate commensurate with the risk you're taking. So from our point of view, we're looking at it and we're saying, if you wish me to lend money or invest in a risky business, you must compensate me for that risk. And I understand there's a risk that I could be wrong and that that company might not do well or as well as I expect, but I'm compensated for that risk on that investment, and overall in my portfolio, I'm compensated for the entire risk of the portfolio. So what you find by our bottom-up value discipline is we're forced away from overvaluation and towards cheap things. So in 2007, when the market had basically lost its head, the average banker, the average investor would buy anything at very, very low interest rates compared to safe investment because they were stretching for yield. And what we were doing was we were looking for safety, because why would I buy a triple B bond at 0.5% over a safe government bond when I could buy a AAA bond at 0.45%. The extra 0.05%, or 5 basis points as we call it in our business, wasn't worth it. But then when everyone was terrified and the market fell and the financial system stopped functioning, we thought it would be bad, but not that bad. We could buy anything we want. We were the only people out there literally buying investments. And we were well compensated then. The one bond that we owned at about 1% over US government bonds, Kimco Real Estate Investment Trust, very high quality company. We bought those bonds at 8 to 10% above government bonds, and we were repaid our $100 at maturity. So we made 30 to 40% on each of those bonds.